As the saying goes, what comes up must come down. There is a substantial difference between a stock market crash and a correction.
That's a good thing.
Yeah.
The stock market can be volatile, and you need to have your strategy in order so that you can enjoy the good times and weather the bad times on Wall Street. Local money expert Bryan is here with some tips. Good morning.
Good morning. And did you hear what Bill just said? What goes up, what did you say?
Must come
come
down.
down.
Well, what about what goes down?
Must come
back
up.
up again. Yeah, definitely.
Well, historically, that is the
There
case
you
with
go.
the stock market.
Maybe not must, but usually.
All right, we're done. Great talks.
We say roller coaster all the time, and that's kind of the way the stock market has been since it was instituted, over 100 years ago.
Well, a crash is a correction in a way, but is a correction a crash, I guess is the first question.
A correction could be, unfortunately, the beginning of something worse, which is called a crash. But a correction is typically it starts moving back up within about 10%, a 10% drop, and then we'll see the prices begin to rebound. Where a crash, we're talking about 20% and a lot more sad, a lot more drama. Yeah. But definitely, we all know that it has happened. So it is fair to say that what goes down eventually, when it comes to equities, it does come back up historically.
Yeah.
If it doesn't, that's a whole other story.
Yes, indeed.
We'll have a special on that later.
Indeed.
Yeah.
So we talk a lot of times about risk tolerance and how much of the up and down you can take, but how can we plan for those ups and downs, particularly if you're closer to retirement?
And a great way is to take financial planning seriously, to seriously take this time when you're listening to this discussion and say, I really need to talk with a financial advisor about my financial plans, about my specific goals, because then hopefully you'll set up a strategic portfolio that will take into consideration your risk tolerance, your time horizon, and then when you have a plan, it will take you through time. It will take you through the best of times and the hardest of times and the worst of times. As I've been a financial advisor for quite a long time now, so I've seen some really bad things happen. I've seen 9/11, I've seen them close down the stock market, I've seen 2008, I've seen us go through what is now called the Great Recession, but the only way that you can get through those things is to actually have a plan and say that these particular parts of my portfolio are for the long term.
And it's not a one-size-fit-all plan. I mean, you work with clients to help them with what they need in their portfolio.
Yeah, your financial advisor should be addressing everything to you. There is a problem if you're all going into the same thing. Your specific needs should be addressed so that your risk tolerance is addressed, so that your weighting in your portfolio is specifically according to how much you can handle. So if you're very conservative and you just cannot handle volatility, see, there's a difference between volatility when we're talking about 1 to 3%, and then we're talking about a correction of 10%, and then a crash. But when you don't like volatility at all, that needs to be communicated, and you maybe cannot handle equity exposure at all. But if you're a long-term investor and you're looking for an opportunity to outpace or keep pace with inflation, then equities should be included in a portfolio that wants to keep pace over the long term.
You've used the term long term about 4 times.
That's
now.
right.
She's trying to reassure us, folks.
That's right.
All right, so what is rebalancing then if we're talking long term?
Yeah, so the rebalancing comes into play to make your long-term investments work for you, because if you don't ever look at your portfolio and make sure it's in alignment with your risk tolerance, then you will miss out on a lot of opportunities. So if you have a balance in your portfolio, let's keep it simple, of just 50% stocks, 50% bonds, equities do well, the market's up, stocks are great, and your portfolio becomes 70% stock and 30% bond exposure. We need to
we're out of time.
rearrange it.
Gone it. It was just getting to the good part.
Yes, it was.
Thanks to our friend JB. She offers money seminars every Wednesday, and Sunday evenings. They're free, but you got to register in advance. WTVR.com/VTM is where you can find all the details.